In the bustling city of London, 1694, a revolutionary idea was taking shape in a coffee house. A group of visionaries, stirred by the economic challenges of their time, contemplated the establishment of a public entity to manage the nation's finances. This entity would later be known as the Bank of England. England in the late 17th century was neck-deep in financial crises. The nation was at war with France, causing the government coffers to run dry. To fund the war, the government had to borrow tremendous sums, but the process of securing loans was chaotic, risky, and unregulated. The country yearned for a more structured and reliable financial system. That's where our group of visionaries came in. They proposed a novel plan, the creation of a public bank that would lend the government the money it needed. In return, the bank would have the authority to issue notes, essentially creating a national currency. This idea was groundbreaking. It promised a system that could manage the nation's debt while providing a stable, reliable currency. The proposal was not without its critics. Many were skeptical of this new institution's power and influence. But despite the controversy, the plan was approved, and the Bank of England was established in July 1694. The bank's early years were not without challenges. It had to prove its reliability and win the public's trust. It had to navigate political pressures and balance its responsibilities to the government and the people. But in time, the Bank of England succeeded in establishing itself as a pillar of the nation's economy. The bank's triumphs were many. It helped stabilize the country's finances, introduced a national currency, and played a pivotal role in funding England's wars. It laid the groundwork for modern banking and set the stage for the financial innovations that would follow. Thus, the Bank of England was born, setting the foundation for England's financial future. Fast forward to the 19th century, a period of remarkable transformation. The Industrial Revolution was in full swing, and the banking system had to evolve to support this rapid change. Enter the Bank Charter Act of 1844. This crucial piece of legislation gave the Bank of England the exclusive power to issue banknotes in England and Wales. This move essentially created a monopoly on the creation of money, which was a significant shift from the previously decentralized banking system. Now, with this newfound power, the Bank of England had to tread carefully. The Act imposed strict regulations on the bank's note issuance, tying it directly to the gold reserves held by the bank. This was a measure to prevent over-speculation and maintain monetary stability. In doing so, it laid the foundation for the modern banking system we know today. The Bank Charter Act of 1844 marked a pivotal moment in the evolution of the English banking system. Now let's delve into the fascinating machinery of banking. There's more to banking than meets the eye. Beyond the brick-and-mortar buildings and digital platforms, a complex system operates, and at the heart of it is one key concept: fractional reserve banking. So, what is fractional reserve banking? Imagine you deposit £100 into your bank account. The bank isn't required to keep all of that money on hand. Instead, it's required to keep a fraction of it, let's say 10%. This is the reserve. The remaining £90 can be loaned out to other customers. Now here's where the magic happens. When that £90 is deposited by the borrower into their bank account, the process starts all over again. The bank keeps a fraction and loans out the rest. This cycle continues, and as it does, more money is created. This is how banks create money, not by printing new notes, but through the process of lending. It's a system that's been at the heart of our economy for centuries. But what's the impact of all this? On one hand, it fuels economic growth. The money that banks lend out is often used for things like starting a business or buying a house. These activities stimulate the economy, creating jobs and wealth. On the other hand, it also means that banks play a crucial role in the stability of our economy. If everyone decided to withdraw their money at once, the bank wouldn't have enough cash on hand to cover it. This is what's known as a bank run, and it's exactly what central banks like the Bank of England aim to prevent. So, there you have it. The ins and outs of fractional reserve banking, an intricate system that, in many ways, is the lifeblood of our economy. It's a system that shapes our financial reality, from the interest rates we pay on loans to the growth of our economy. Fractional reserve banking, an ingenious system that keeps our financial world spinning. Interest rates and monetary policy, two terms that dictate the rhythm of the economy. Let's dive in. Interest rates, simply put, are the cost of borrowing money. When they're high, people think twice before taking out loans, cooling down economic activity. When they're low, borrowing becomes cheap, and the economy tends to heat up. Now, who sets these rates? That's where the Bank of England comes in, wielding the tool of monetary policy. Monetary policy refers to the actions taken by a central bank, like the Bank of England, to control the supply of money and, in turn, influence interest rates. Through this, they aim to maintain price stability, control inflation, and support economic growth. The Bank of England, for instance, might lower interest rates to stimulate spending during a recession or raise them to cool down an overheating economy. So there you have it. Interest rates and monetary policy, the invisible puppeteers of the financial stage. Fast forward to the present day, where the banking system faces new challenges and opportunities. In the current economic climate, the English banking system remains a robust and resilient force. With the scars of the 2008 financial crisis still healing, the system has proven its ability to weather economic storms. Banks have embraced stricter regulations and tighter controls to prevent a repetition of the past, while also bolstering their capital reserves to safeguard against financial shocks. However, resilience doesn't mean immunity. Today's banking system grapples with a new breed of challenges. The digital age is transforming the way we transact, save, invest, and even perceive money. Traditional banks find themselves in a race against time, having to adapt and innovate to keep pace with the shifting sands of technology. In the face of digital disruption, banks are rethinking their strategies. Online banking, mobile apps, contactless payments, these are no longer luxuries, but necessities. Banks are investing heavily in technology to enhance customer experience and streamline operations. However, this digital transformation isn't without its hurdles. Cybersecurity threats loom large, and banks must remain vigilant to protect their systems and customers' data. Furthermore, the rise of fintech companies and digital-only banks pose a significant threat to the traditional banking model. These new players, unburdened by the legacy systems of traditional banks, are nimble, innovative, and customer-centric. They offer a range of services, from digital wallets and peer-to-peer lending to robo-advisors and cryptocurrency trading, that challenge the dominance of traditional banks. Yet, despite these challenges, the English banking system is far from being rendered obsolete. Banks are leveraging their vast experience, trust, and customer base to stay relevant. They are partnering with fintech companies, adopting new technologies, and even creating their own digital-only brands. The digital age presents both challenges and opportunities. It's a brave new world, and the English banking system is evolving to thrive in it. In the face of change and adversity, the English banking system stands resilient. With the rise of fintech and cryptocurrencies, the face of finance is changing. The English banking system, renowned for its resilience and adaptability, is not shying away from these innovations. Instead, it's embracing the challenge, integrating technology into its core operations. This shift is evident in the surge of digital banking platforms and the growing use of blockchain technology for secure transactions. But that's just the tip of the iceberg. Cryptocurrencies, once a fringe concept, are now part of mainstream conversations. Banks are exploring ways to incorporate these digital assets into their portfolios, signaling a potential shift in how we perceive and use money. And it doesn't stop there. With the advent of artificial intelligence and machine learning, the future may hold a banking system that's not just digital, but also intelligent and predictive. As we stand on the brink of a new era, the English banking system continues to evolve. The journey ahead is filled with opportunities and challenges, promising an exciting future for the world of finance. Now, it's time for the grand reveal. We've embarked on a fascinating journey, from the historic coffeehouses of 1694, where the seeds of the Bank of England were sown, to the Industrial Revolution, where the Bank Charter Act of 1844 reshaped the monetary landscape. We've dived deep into the mechanics of banking, unraveling the mysteries of money creation and the implications of fractional reserve banking. We've shed light on the complex world of interest rates and monetary policy, and how they influence our economy. Moving forward, we've navigated through the challenges and transformations of the modern banking system, exploring its resilience in the face of economic storms and its ongoing evolution in the digital age. The rise of fintech and cryptocurrencies hint at a paradigm shift, signaling the dawn of a new era in finance. From the coffeehouses of 1694 to the digital age, the English banking system has come a long way.